This is just a quick video showing why many Forex indicators such as Stochastics, RSI, MACD, and other oscillators don't work, and why. And more importantly, what does work and what you can use to predict likely future Forex moves. Stochastics is basically an oscillator that shows overbought and oversold. And most people use it when it gets to the bottom level and flips up. You look for a buy. When it hits the upper level and flips down, you look for a sell. So you have, sells, buys, buy. It looks pretty good so far until the market starts to trend and stops going in a choppy phase. You can see a sell right here. This one's a loser. This one right here is obviously a winner, but it got you into the trade a little bit late. This one right here obviously is a winner. Now if you use this in combination with just analyzing the swings, in other words, it made a higher swing and so you buy the next pullback and use this as a crossover method, it can be helpful. But when if you don't realize that this is now an uptrend because it made a higher high and a higher low, then you might be taking a sell right here, which really doesn't work. This buy right here, oftentimes up near the highs, the trends reverse and you're buying the highs, and that fails. In this instance it works. Most people use it as a extreme overbought oversold indicator. You can see this one right here. You would have probably been in here. It barely went 5 pips your way without going up again. Same exact thing here and again here. Notice a false trade here and a false the second trade works. Why? Because it's in an uptrend. It tends to be a decent way of getting into trends after a decent 25-30 pip pullback right here. So that's the stochastics, and one of the reasons I don't like it is because if you use it as it was mostly designed for, it has frequent losing trades. Especially most people want to trade with the trend. The biggest profits and the highest probabilities are with the trend, and it gets overbought, oversold way too soon. It's saying that the market is done going up right here, and yet the price continues up another 40 pips. And it gives a sell signal right here that's wrong, sell signal right here that's wrong, and ultimately, this trade right here, it did pull back, and this one worked. But it failed 3 times before those 2 trades worked. Here's the RSI, and it also tends to give sell signals in uptrends and buy signals in downtrends. Basically, when it hits the minus 30 level, you're looking to buy. It hits or gets close to the upper level, you sell. That doesn't technically, meet that criteria. And you have a buy here that, and you can see it made a lower low, and it's in a downtrend, and you're actually looking to buy a downtrend. It goes up, 15 pips, and then immediately comes down. If you're looking for bigger moves, this is going to find smaller moves. Obviously, it was right here because the trend reversed and made a higher high. And if you wait for it to reverse back underneath that level, you got short right here. So it's a little bit lagging. You can see this trade right here obviously failed. The price didn't go down. Give another sell signal here. That also did not go down. This pullback here didn't quite hit the oversold area, but if you bought right here, it did a pretty good job of nailing the low and finding the next move up. And you can see during choppy times with low volatility, it also is wrong a lot. Not telling you to buy here, here, and here, and only 1 out of those 3 works. So that's the reason why I don't like the RSI. Now, another thing to keep in mind is something called the drop-off effect. Whether you're using most oscillators, they have a period that they use. In this case, the default is 9. The stochastic is 14 bars, and basically what that means is 9 bars back. If when the new bar forms, that previous 9th bar back now drops off. And so if it was a very significant level like this right here, 9 bars into the future, that big down bar is going to drop off, and it's going to cause a spike up in the RSI. It's not based on what the current bars are doing, but only because the previous bar had a drop-off effect. You'll see that the exact same thing with this. 9 bars, or 10 bars I should say, in the future. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Right here, you can see that it's hard to see in this particular instance because the market's going up at this time. But if the market started to go down, having that big up bar drop off is going to have this radically move in the other direction. So the drop-off effect can really affect what the indicator looks like, and that's the main reason why I don't like oscillators. That combined with all the false trades, too many trades, its tendency to have the ability to show sells in an uptrend and buys in a downtrend with frequent losses. It only is right at the peak of the move. When it's done going up and starts to go down, it's right. When it's done going down and starts to go up, it's right. But most of the other times, with the exception of multi-hour swing down like this was a gradual, slow move down, and of course it was right. That was the best signal of the day. Our systems would be looking to buy this as well, mainly because it's coming up to the 38% Fibonacci area, or getting close to it at least. Here's the MACD, and most people use this as just a simple crossover system. So when it crosses from down to above the signal line, you go long, and then you go short, and you go long, and you go short, long, short, long, short, long, short. The market's frequently choppy, long, short, and basically this gives a ton of trades. Most of them, or a lot of them, are losers. And if you use this also in the direction mainly of the trend, in other words, if you use it as when this makes a higher swing here, and you wait for a pullback, and then you take the next crossover, notice this crossover right here gets you into the trade pretty late. You're already 1, 2, 3, 4, maybe even 5 bars into this trade when it crosses over. And for that reason, because it's a moving average convergence divergence, it uses moving averages by default. It's going to be laggy. And so that's the main reason I don't like this. If you wait for a decent pullback like this, and then you see a crossover, this crossover, happened right here. A pretty decent place to get in. I would be looking to buy the breakout of the trend line right here, maybe 1 or 2 bars early, but nonetheless, it did a pretty good job at that time. So that's the reason I don't like the MACD. It also suffers, although a little bit less, from the drop-off effect, because it uses an exponential moving average, and those tend to weight current bars more than past bars. So there's much less drop-off effect, but it can slightly affect this indicator. Here's our perfect oscillator, which I've named perfect for many reasons. It shows real overbought and oversold levels based on past volatility levels for that time of the day. So during the lower volatility times of the day, we're looking back over the last 20 days, and we see what the volatility is normally during that time. We're comparing current volatility to that time of the day. When the market's ripping and roaring, we're using a higher volatility level, and we're comparing today's higher volatility level to that. In addition to just the oscillator itself, with the plus 80 being extreme overbought, it's likely to go down, minus 80 oversold, likely to go up. We also have a moving average of this oscillator and Bollinger Bands plotted around it, which I'll get into in a second. So one of the many ways of using this is when you hit a plus 80 level, you sell. When you hit a minus 80 level, you buy. So these are all the buys and the sells. And as you can see, this one went up slightly. This one went up. And notice the accuracy of the timing. Big move up. This one's a failure. Nailed that one. Nailed that one. This one, the market did pull back about 10 pips, so you could have got out of that with a small loss. And of course, this one did well too. So you have small win, or at least opportunity to break even, small wins, decent win, big win, loss, win, win, small loss, break even, and win. So the accuracy of this is much better than other oscillators. And like I said, one of the main reasons for this is we use statistics. We compare the past. There's no drop-off issues with this, because we're actually just comparing the 5-minute chart to the past statistics for that 5-minute chart. There's no number of bars back, which means if I'm not using 10 bars back or 15 bars back, there's no drop-off. There's nothing to drop off. We're comparing current price, and that's another reason why this is so much better than other oscillators. The current value of the perfect oscillator is the current value of that very complex algorithm for that bar compared to that time of the day in the past. And you can put this on multiple different time frames. If you want to see a perfect oscillator on a 50 tick chart or 5 pips per bar range chart, you can do that. You can compare multiple time frames. You could have hourly perfect oscillator on your 5-minute chart. There's no limits of what you can do. So you can actually analyze multiple time frames using this to see how much overbought or oversold it is. Now that was the first way of using this, is the plus 80 and the minus 80 is overbought or oversold. Again, if I click on this, you can see it nailed the high. It nailed the low to the bar. No delay. I mean, you're maybe 1 bar late, but nonetheless, it shot up. Obviously, this is a failure right here, but the market did stall there. And that's typically when these don't work, they stall. And another thing this shows you is when they don't work, because it is such a highly accurate, and it's based on statistics, that's why it's so accurate, indicator, when it does fail, guess what? That is one strong trend. Want to buy the next pullback. You can see it did a very good job of nailing the low right here, and it caught the biggest move of the day, and you spotted that basically because this tool failed. So when it fails, ultimately, if you were paying attention and in the future you're there, you can get your loss back by seeing that it failed. Another thing I like about this, in the other oscillators don't do this, is because we have the moving average and the Bollinger Band plotted around there, if you see a strong uptrend, you can buy pullbacks to the 0 level and also the lower band. So you can see this big move up here. This pulled back to the 0 level, pretty safe place to buy. Went up again, pulled back to the 0 level, pulled back to the lower Bollinger Band around our perfect oscillator, and of course did so again here. And this one failed, obviously. Eventually trends end. But by using our tool, not only are you able to pick the extremes, but you can get into trends on minor pullbacks, minor pullbacks, minor pullbacks, minor pullbacks. 3 of these 4 trades worked. You can also use it, when you see a trend like that and you have a multi-hour pullback like this, when it crosses, the moving average of the perfect oscillator, or you have a little trend line you visually eyeball on here, when it breaks out right here, pretty high probability and also a little early warning sign that it's likely to go up, and within about 5 or 10 minutes it does. It only shot up about 20 pips. But this is a trade that you can use to, possibly get into trades a little early, and therefore usually with better entry criteria, tighter stops, and a better opportunity of catching many multiples of your risk. If you're only risking 5 or 6 pips and you catch a 20 pip move, you potentially have 4 times bigger profit than your risk. That allows you to not have to be right a very high percentage in order to make money trading. So that's another reason why I like our perfect oscillator better than most oscillators. So last but not least, I'd like to show our currency indexes, and this is possibly taking a little bit more complex than most new traders would want, but this lets you see what the euro's doing, what the dollar's doing as a chart. And you can see the euro is trending up, it's kind of going sideways right here. It's in a nice little tight range. It's above its hourly moving average, so is the dollar. The dollar is above its 15-minute moving average, and for the most part, it's stronger than the euro. So the euro is kind of going sideways. Ideally, it would be underneath its hourly, then you would sell the weak euro versus a strong dollar. The dollar, you can see, comes up and forms kind of a double top, a slightly lower high, and then breaks the trend line, which also is very close to the 15-minute moving average. At 7:30, the dollar is very likely to go down, and the euro, right before that, made a higher high, and you have a nice little pullback right here. By the way, you can put the perfect oscillator on our currency indexes too. You can't get these currency indexes anywhere else. So this is a very high probability place to be buying the euro. It's very strong. It's above its 15-minute and hourly moving average. We obviously use much more sophisticated methods than this. You can watch our Forex blogs. This is a simplistic and easy way for brand new traders to analyze these. The euro is likely to go up, and a little bit after 7, the dollar breaks underneath its 15-minute moving average, and it does a retest there. Very likely to go down. The euro is very likely to go up, and therefore around 7:30, you want to be looking for euro-dollar buys. Here's an actual chart of the euro dollar. Remember, between 7 and 7:30, we're looking for a buy here. And, you know, in this case, I don't like to get into trades a little bit high like this. I prefer to buy pullbacks. I would have probably got in there with my stop underneath here and been in this trade already. But at 7:30, it gives you a go-ahead to really aggressively look for buys. Now, this is a 5-minute chart. If you use range charts, 5 pips per bar range chart, you're going to find a much better end. So here's a 5 pips per bar range chart for the euro dollar. And again, around 7:15, 7:30, you want to look for buys. Typically, you can kind of eyeball a decent sized move. These are 5 pips per bar. Every time it moves 5 pips, there's a new bar. So, you know, you have a big move up, a little pullback. You could always go long right here with your stop underneath here. It went up 1 bar, made another wick. Wicks tend to be reversals, as you can see. So you move your stop up. Guess what? You lose 3 or 4 pips here. Pulls back again, slightly lower low. You put your entry here. When it goes 1 pip above this bar's high, you get it out right here, and you have very almost ideal Fibonacci profit targets to use as exits. So in this instance right here, this is your risk. This is your likely profit target. It's many times bigger than what your risk is. And you see by looking at the currency indexes, the euro is still strong. So you take the next little pullback right here, pulls back, goes above that bar. You put your stop a pip or two underneath the low. You draw your fibs on there from here to here, and it's probably giving your fib targets up here. But even though it's already gone up 1 wave, small little wave, another wave, it's going to run out of steam more than likely. But your risk versus your reward still makes it worth taking. So using our perfect oscillator on the chart, using our range charts, using our currency indexes to actually see visually what each currency is doing and what its trend is and when it's likely to reverse. Double tops, double bottoms tend to be reversals, trend line breaks, breaks from below to above or above to below moving averages. There's, you know, literally 50 different ways to find likely future trend direction using our currency indexes. And when you see that the euro was strong and the dollar was likely to go down, you look for buys, and you know, using our range charts, a perfect oscillator, and we also have Forex signals, you can improve your odds dramatically over, you know, basically ancient tools such as the RSI, MACD, Stochastics, and some of the other oscillators out there.